The S&P 500 isn't just a number, it's a snapshot of America's biggest companies and a barometer for the entire U.S. economy. When you hear the market is up, it's usually the S&P 500 making headlines. This index tracks 500 major companies, from Apple to Amazon, reflecting the health and direction of the market. Its movements reveal investor confidence in economic trends. Rising S&P 500, that's optimism about corporate profits and the economy's future. So, when a major bank like Barclays updates its forecast for the S&P 500, it matters. These forecasts are data-driven roadmaps, not crystal balls, guiding both Wall Street pros and everyday investors. For anyone saving for retirement or college, these predictions offer a glimpse into what could shape your investments. When Barclays changes its outlook, it's more than a number. It's a signal about risk, opportunity, and the economic road ahead. Understanding these shifts helps you connect market news to your own financial goals. It's the first step to making sense of your financial journey. The S&P 500 isn't abstract, it's directly tied to your future. Let's see why Barclays' latest forecast is making waves. On March 24, 2026, Barclays raised its year-end S&P 500 target to 7,750, up from 7,400. That may sound like a small bump, but in trillion-dollar markets, it's a big deal. The upgrade is rooted in higher expected earnings for S&P 500 companies. Barclays now forecasts $321 in average earnings per share for 2026, up from $305. Stronger earnings are the foundation for higher stock prices. Interestingly, Barclays actually lowered the valuation multiple, meaning their optimism isn't about hype. It's about real business growth. They're betting on companies being more profitable, not just investors paying more for the same profits. This is cautious optimism, higher earnings, but a realistic view of risks. The new target reflects confidence in American business resilience and innovation. By slightly lowering the multiple, Barclays is building in a buffer for uncertainty. This isn't a wild guess, it's a calculation based on stronger fundamentals. For investors, it's a sign that the market's strength is grounded in real performance, not just speculation. Barclays' new target is a statement. The business foundation is stronger, but risks remain. It's a nuanced, data-driven outlook. Let's dig into what's driving this optimism. Barclays' optimism comes from a mix of positive trends. First, corporate America is delivering strong profits, with companies themselves projecting solid futures. The U.S. economy is proving resilient. Barclays expects 2.6% GDP growth in 2026, powered by steady consumer spending. A healthy labor market means people have jobs and money to spend, directly benefiting S&P 500 companies. Manufacturing is rebounding, with factories busier and orders rising, signaling broader economic strength beyond just tech and services. This industrial momentum boosts demand for materials, energy, and transportation. Barclays even upgraded its view on the industrial sector. Inflation remains sticky, but stable, giving the Federal Reserve room to avoid drastic moves. Stable prices help businesses plan and invest confidently. Together, strong corporate guidance, resilient consumers, a manufacturing rebound, and manageable inflation form the backbone of Barclays' higher forecast. It's a story of broad-based economic durability. The foundation for growth is solid. But what's powering the biggest gains? Let's look at technology. Technology remains the market's powerhouse, and Barclays believes its leadership is far from over. Tech companies are not just meeting expectations, they're exceeding them, especially with the surge in artificial intelligence investment. AI isn't a passing fad. It's a long-term force reshaping industries and driving massive spending on chips, data centers, and software. This investment cycle benefits not just tech giants, but also utilities, energy, construction, and software firms. The AI boom is lifting multiple sectors, not just tech alone. AI is becoming economic infrastructure, like roads or electricity in past eras. Building this infrastructure is a multi-year project, generating huge revenues for leaders in the space. Barclays' confidence in tech, and AI in particular, is a key reason for its higher earnings and market targets. The tech sector's strength is more than hype, it's a fundamental shift in how the economy operates, but even as AI drives growth, it brings new risks. No forecast is complete without acknowledging risks. Barclays warns that while their outlook is positive, the risks are real and could have significant impact. Geopolitical instability, like ongoing conflicts in the Middle East, can disrupt supply chains, spike energy prices, and shake investor confidence. Private credit markets are another concern. Higher interest rates could trigger defaults and ripple through the financial system. Barclays' bear case scenario sees the S&P 500 dropping to 5,900, a 15% correction from recent highs. This isn't just a hypothetical, it's a reminder that markets don't move in straight lines. Even in a strong economy, shocks can cause sharp downturns. Investors must be prepared for volatility, not just growth. The path forward is never guaranteed. Let's look closer at the double-edged sword of AI. AI is both the engine of growth and a source of risk. On the upside, AI promises breakthroughs in healthcare, logistics, energy, and education, fueling innovation and profits. The companies building AI tools are poised for tremendous growth, driving the market's bull case. But AI's disruptive power is just as real. Automation could eliminate millions of jobs, disrupt entire industries, and create social and economic turmoil. Companies slow to adapt risk being left behind. The transition may not be smooth. Job losses, inequality, and regulatory backlash are real threats. AI could also concentrate power among a few tech giants, creating new systemic risks. The ultimate impact depends on how society and businesses navigate this transition. AI is a powerful tailwind, but also a potential storm cloud. Investors must weigh both sides of this technological revolution. So how are investors reacting to all this? Despite strong market performance, investor sentiment is confident but not euphoric. There's limited fear. Investors aren't panicking or rushing to buy protection. Long-term funds are taking some profits, showing discipline rather than chasing the rally. Hedge funds are also reducing risk, not making aggressive bets. This cautious approach suggests the market is climbing a wall of worry, not floating on a bubble. Importantly, there's still cash on the sidelines, potential buying power if the market dips. Not everyone is all in, which means the rally could have room to run. The absence of wild exuberance is a healthy sign. The market's mood is steady, not reckless. Let's see which sectors Barclays thinks are best positioned. Barclays' forecast isn't just about the overall market, they've pinpointed sectors with the most promise. Technology and financials are expected to drive the bulk of earnings growth. Industrials have been upgraded to positive, thanks to manufacturing momentum and the AI-driven data center boom. This blend of old-line manufacturing and new tech makes industrials especially attractive. Materials and energy, once out of favor, are now rated neutral as supply disruptions support commodity prices. Stabilizing prices mean better profitability for these sectors. The recovery is broad-based, not just about tech. Diversification matters. Opportunities exist across the market. Barclays' sector view highlights a healthier, more balanced expansion. For investors, it's a reminder, don't just chase the obvious winners. So, what should you do with Barclays' new, higher forecast? First, don't make drastic changes based on a single prediction. The best lesson is to stay the course. Long-term investing in a diversified S&P 500 fund remains a smart strategy. The drivers of growth, innovation, resilience, and technology have powered markets for decades. But remember, risks like geopolitical shocks and AI disruption are real. Diversify, invest only what you won't need for 5 to 10 years, and stick to your plan. The fundamentals of sound investing haven't changed. Automate your savings, invest consistently, and keep costs low. Let this forecast give you confidence, but stay humble. Unexpected challenges are always around the corner.